much. Good evening, everyone. So as I'm talking about the Fidelity European Trust, I thought it'd be great to start with just a bit of a near-term outlook for European equities, because our underlying investments in the trust are predominantly Europe ex-UK businesses. Unfortunately, I'm not going to start with a particularly uplifting thought, because there are, as quite often in Europe, some dark clouds overhead. So obviously we're all aware of the current tariff situation. Even though we're in this 90-day pause at the moment for negotiations, we're still in this uncertain period where we don't know where we're going to land. And even if we go back to a position where the tariffs imposed are nowhere near as bad as we were initially led to believe by Trump and his government, it has created this period of uncertainty for businesses, nobody really wanting to make investment decisions at this point in time and commit capital when they don't really know what's going on in the world. That has created a risk of recession and a situation where we don't really know what the ECB and the Fed are able to do in terms of their monetary easing, particularly if inflation ends up being much stickier than it has been. On top of that, we have businesses who were very canny in the COVID period about setting their debt levels and financing their debt at very close to zero interest rates. And if that was set at a 5-year, for a 5-year period, now in 2025, we are coming close to those levels of debt now having to be refinanced at much higher levels of interest. So that is a worry for many European companies. And then we've got consumer spending that until recently has held up pretty well, but in recent months has showed signs of rolling over. So quite a few near-term dark clouds for sure for Europe. And when we think about the longer term outlook, things don't get much better. There are poor demographics, low productivity, high levels of government debt. And these issues have been around for Europe for a long time, but if anything, they have got even worse in the last few years. But before you will kind of walk out the door and think, oh my goodness, there's no point in investing in Europe at all, please don't do that, because the silver lining here is that European companies are not the same thing as the European economy. And the simple reason for that is that around 2/3 of the revenues generated by European companies comes from outside of the region. So this chart is showing for the MSCI Europe ex-UK index, where revenues are generated. So around 35% come from within continental Europe, but emerging markets and North America are almost as important a market for European companies as Europe itself. And the fantastic thing about the Fidelity European Trust is that we are active portfolio managers. We can select the absolute best companies from within the investment universe. And that has generated really good levels of returns for our investors over the long term. And that is really illustrated by this, what I think is a really brilliant chart that I've now brought up. Unfortunately, my compliance team have said I've got to also show the table with the performance numbers on. So we're not seeing the chart in its full beauty across the whole page. But hopefully you can still see some of the detail. So what this chart is showing is the bottom two lines, the yellow and the orange. So orange is the FTSE World Europe ex-UK, so the European market. And that has pretty much kept pace neck and neck with the MSCI World Index over the last 30 years. And I think that's quite remarkable, because if you think about what's gone on in Europe in those 30 years, it's been lots of things ending in the word crisis. Eurozone crisis, debt crisis, migrant crisis, Brexit, almost a Grexit, loads of negative things. In the same time period, lots of positive things for the rest of the world. So bringing 1 billion people out of poverty, you've had China emerging, India emerging, the US going from strength to strength. And we can see that in the US stock return, the S&P 500 up 11.5% per annum over the same period. But what we can show from this is that by investing in some great European companies that have benefited from the growth in the rest of the world, you can get very, very good returns. So LVMH, for example, has benefited as much from the emergence of the Chinese middle class as any other, as any Chinese company has. Novo Nordisk has really benefited from the increase in health spending in the US as much as US healthcare companies have. SAP really benefiting from the rise in tech spend. So by investing in these companies, you can see the NAV return on the investment trust over the same period has even beaten the S&P 500. Normally, so up until maybe 6 months ago, our presentation would have probably ended there and I would have had loads of time for questions. But I think things have really changed for Europe over the last few months. And it's probably worth exploring some of that because there are now some really strong silver linings for the European market. And that's really come from what the US has been announcing and some of the, I guess, for want of a better word, the kicks that and the wake-up calls that the US has delivered. Firstly, in the form of tariffs, obviously, and us having to think about that. And secondly, the security umbrella for Europe being diminished somewhat. So we've seen the reaction to that. So Germany has been very bold in coming out with talking about lifting the fiscal debt brake. So they have been living under a self-imposed fiscal regime that's been incredibly conservative for a long time. And they are now paving the way for more investment and that debt brake being lifted. Hand in hand with that, they're talking about increasing their defence spending, and we can expect defence spending across other European countries to start to increase as well. We've also had the Draghi report on EU competitiveness and cutting red tape. So I guess the kind of holy grail for Europe is that tighter integration, not just the monetary union, not just the freedom of movement, but really coming together a bit more with other efficiencies on a Europe-wide scale. I think we're a long way from having a United States of Europe, but something a bit closer to that would be a lot better than the situation we're in now, where it's just a lot of bureaucracy and red tape. And finally, the European region is just well known for having a very high savings rate, and European investors in particular keeping a lot of those savings in cash and real estate rather than in the stock market. But if there is an encouragement that we need to finance these investments in the German infrastructure, in defence spending, and perhaps an opportunity for individual investors to participate in that through financing some of these projects, then it can be a win-win by private investors helping as well. So there are several things that could definitely help the European market through those kicks that we've been getting from the US. I think my flickers seems to have jammed. Yeah. I think it's just worth thinking a little bit about exactly how far ahead the US has gone versus Europe over the last 30 years or so. So back in 1994, GDP per capita in the Euro area and the US was fairly close, kind of between 20,000 and 30,000 USD. But fast forward 30 years, and that gap has really widened. And now the GDP per capita in the US almost double that in Europe. And it's not because US are particularly more intelligent than we are. That it's not because they've got some secret technology that they're using to become, that much better. It's really all about the productivity gap that's opened up. And the US, part of that, around 30%, is down to the fact that the US workers tend to work longer hours, 30% longer hours than Europe. And I don't think that's probably going to change anytime soon. I can't see European labour laws moving very swiftly to have longer working hours. But the rest of it is all down to productivity, so 72%. And it's all about, you know, the differences in the fact that the US is such a huge market with, you know, common laws throughout the region, an environment that's really set up for innovation and excellence and moving forward, versus in the EU, those kind of red tape and bureaucracy that I've alluded to. So potentially we are at a point where we can start being a bit more confident about Europe as a region and having some self-help measures. But unfortunately, it has come at a time where those near-term uncertainties on tariffs and the potential recession could hit. So it's very difficult to call exactly when things will turn. So within the European Trust, so this chart is showing how the revenues within the trust are split between the regions versus the index. So you can see that we're at the moment quite in line with the index in terms of our exposure to continental Europe. But we are thinking about this in our individual stock picking right now, and particularly trying to identify companies that will be domestic champions within Europe, really poised to benefit from any macro uplift that we will see from this infrastructure spending and the increased focus within Europe itself. So a company that we've recently added to the trust is Ryanair, which is a kind of great domestic champion. It's will really benefit from growth in the economics in the region. So this is a chart just showing how badly European equities have done versus the US over the last 20 years. So almost at any point on this chart, it would have been correct to be underweight Europe, overweight US. And if you take a magnifying glass right to the end of the chart, you can see Europe has taken a slight valiant recovery in the last few months. But we've still got a really long way to go to any sort of mean reversion of performance of European equities against the US equities. But, perhaps if we do start seeing some of the self-help, there is some argument for people to start looking at the region. And we have started to see that happen in terms of asset flows into Europe this year. People starting to question US exceptionalism, questioning the fact that, the consensus is to be overweight US equities, perhaps a bit of diversification into Europe if there is some poise to for the self-help and the recovery to come through. So potentially still a long way to go in this trade. And the result of that 30 years of underperformance or 20 years of underperformance is that European valuations are still looking really attractive versus the US. And even if you strip out big tech companies, still on 13.7 times for Europe and 18 times for the US ex big tech. The relative valuation is still looking very compelling. And then the final point I wanted to make is just about how things can change over time. So maybe thinking, but it's just impossible to think that European companies could ever be as big as some of the US names today, but it has changed. So back in the 1980s, the majority of the top 10 biggest companies listed in the world were US businesses. But by the 1990s, it was actually Japanese companies that were really dominating that top 10. 2000s, it swung back to a US dominance. But 2010, we saw emerging market companies starting to come through. So a few Chinese listed names and Petrobras in Brazil as well. 2000s, clearly the US dominant again, but 2030, could this be the decade of seeing some European companies among those top 10s and starting to dominate? So to bring it back now, instead of just trying to think about which way the wind will blow for European equities, I think it's probably worth talking about what we're focused on at the Fidelity European Trust. And we remain focused on companies that manage to consistently grow their dividends. For those of you not familiar with the investment trust, it is managed by lead portfolio manager Sam Morse and his co-PM Marcel Stotzel. They are supported very importantly by our equity research team, plus the other teams you can see listed below on sustainability, credit research and trading, etc. So what the team are really looking to do is summed up in this slide. And it's about looking to identify companies that will consistently grow their dividend for the long term. And we can see from this chart that the blue bar on the far right, that 56 companies have managed to grow their dividends consistently over the last 5 years. That's versus 263 companies in the Europe ex UK index that have either held or cut their dividends. And you can see the massive performance difference between those groups of businesses. So those 56, generating median cumulative return over 70% versus more like 35% for the others. So what we're trying to do with the investment trust is identify which businesses will be in that 56 blue bar, because you can guarantee it won't be exactly the same ones in the future, but trying to look at by fishing in that pool for the kinds of companies that will be in that blue bar going forward. And we do that by looking for the attributes that we've listed there. So the positive fundamentals, cash generation, strong balance sheet, and the and there should be a bit more prominent, but we definitely need to marry that with an attractive valuation. So things we're focused on, it's really about bottom-up stock picking. That's where we think our secret sauce lies at Fidelity International. We're not really looking to predict the macro side of things. We look to be long-term investors, so the portfolio has fairly low turnover. That helps to reduce transaction costs, which is a positive. And we're not too influenced by what's going on a quarter-by-quarter basis in companies' earnings. And it's a very cautious approach. So our portfolio managers are paying more attention to what can go wrong rather than the potential upside for stocks. And in periods like COVID, like when the Ukraine war kicked off and it was, very nervous times in the stock market, by holding companies with a quality bias, with that consistent dividend growth, the trust really preserved capital much better than the peer group. So our outperformance has been very strong. What we aim to do is actually outperform only by 1 to 2% per annum, which doesn't sound very much. But over the long term, that does translate into very nice compounding for our shareholders. You can see we have generated this. So this chart is stretching back over Sam Morse's tenure and exactly 2% per annum outperformance over the index. So I think I've almost got to the end of my time. But I'll just leave you with this last slide, which we're really proud of, that the investment trust was recently recognised on the ISA Millionaire list. So if you had invested your full ISA allowance over the years in the Fidelity European Trust from 1999 onwards, it would have grown to over £1 million tax-free. So we're really, as I say, really proud of that. And it just shows that by having these steady growers that are just outperforming by 1 to 2% per annum, you can generate a really healthy return over the long term.
Well, thank you, Natalie, for that good presentation. Yesterday, our esteemed Prime Minister claimed to, or appeared to turn his back on Brexit. That's one thing, but he says that the UK now faces a very attractive and prosperous future, even 12 years ahead, because we're turning our attentions back to Europe. I don't know if you had any chance at Fidelity to assess all that yet, I assume not, but would you expect, if that happens, that it would be positive for the sort of stocks you hold in your European fund?
Well, I think it would be, because even though, we're obviously talking about, European listed names, but they do quite, the UK remains a very big part of that business as well. So I think if we, kind of going back to that chart I had on, I think it's locked, but going back to the chart on the revenue exposure, I think about 10% of the revenues for Europe come from the UK. So that the trading relationship is very important, and it works both ways for sure. In terms of working through the detail of what because these things change so much and the policies take time to come through. You don't know if there's going to be a change of government before new things come in. That's why we try to think about what individual companies can do and their reactions and how they're investing for the long term, rather than worrying too much about the short-term political backdrop within that. But yes, obviously it can the wind can blow in a positive way politically, and that can help. And that we've seen that through Germany as well in their announcements on infrastructure spend.
And a question here, please. Yeah, just where the second for the microphone, please. That's right. Thank you, Steve.
Yes, thank you for your presentation. I thought that the Draghi report was a powerful and perceptive piece of analysis on the problems. And what I didn't see in it was a prescription for change that would address these problems and bring about something positive. Now, of course, there may have been some tectonic shifts within policy within the EU which has addressed that and made things a lot better. Do you have any more positive thoughts on it than I have had?
I think it's about incremental change and the incremental positives that can come. I take your point. Europe is notoriously slow for working through these kinds of issues. But I think, there will be increases in spending and that will come through at some point. There will only be certain companies that can benefit from that. So we do have some thoughts in particular about defence spending at Fidelity and how that will come through, because you've seen share prices in defence companies move very rapidly to discount that increase in spending. And defence companies do tend to be quite opaque with their accounting. It's questionable whether governments are really going to let private companies make huge profits on the back of this. It's there as a public good. So there are nuances for sure. And it's about small improvements on what has been in the past, rather than maybe a wholesale change in one step, which would be nice. That it is a holy grail, and we're not there yet for sure.
Thank you for a very interesting presentation. And I am a shareholder, so I have a vested interest in listening to what you have to say. Something that struck me particularly was that, if I interpreted it correctly, the number of dividend growers recently was 56 and was a diminishing number, having gone down from 200 and something to 100 and something to 56. And in the opposite direction, the dividend shrinkers were increasing.
Yeah.
And I'm assuming that those figures are based on the funds the companies that you're invested in, rather than the market as a whole?
No, that's the market as a whole. And the reason for that reduction in numbers is because in the last 5 years, we had COVID. So many companies just had to stop paying their dividends over that period. Some of them were forced by the French government, for example, didn't want companies paying dividends. So that was a kind of regulatory issue. Others, because of their revenues went to zero or thereabouts, had to pause their dividends through that period.
Okay, thank you very much for clarifying that. But in parallel with the overall thought, do you think that the outperformance that you have had could be increased by consolidating the number of holdings you have to a smaller number, being more focused?
So that's not so to be clear, the numbers on that slide were for the market as a whole, rather than the stock holdings in the portfolio.
That I understand, but it suggests that if you're looking at the market as a whole, one would have done better by being increasingly consolidated against the winners.
Well, so the pool of stocks is that kind of 56. We're never going to be able to pick every single one of those 56, but what we're trying to do is identify as many of those in the future that would be the ones that grow their dividends consistently.
It's
terms
the
of the
relative
number
difference
of
that I think is
holdings-
interesting.
Yeah, I'm
'Cause
trying to.
you've got a significant number. If we can find that one again.
So, but the
possibly.
number of holdings in the trust is between 40 and 50.
Right. Okay.
So relatively
So it is
consolidated
relatively
anyway.
consolidated.
Yeah.
'Cause it from that, it became increasingly important to pick the winners rather than
Absolutely.
the average. And if you could pick the winners, then you were going to outperform to a greater degree, it
Yes.
would appear statistically.
Yes. Yes.
Okay, thank you very much indeed for
Yeah.
clarifying that for me.
Do we have any other questions from Natalie, please? Otherwise, I've got, actually, you might have it on one of the slides, which you've not gone through. Could you talk through the top 10 and the geographic split for the portfolio, please?
So I'm not sure if I've got the geographic. Not sure if I've got the geographic split totally by domicile, but we've got the ones for the top 10. So the main observation about the top 10 holdings is the kind of diversity in terms of types of businesses, sectors, country of listing. And we're really looking for that diversity across the portfolio. So we don't want any one theme or sector or company to be driving the returns. We try to keep the sector weightings within the portfolio within plus and minus 5% of the index. And that is really as a kind of risk mitigation tool. So there aren't that many companies in the energy sector, for example, that you would want to have exposure to. They're not brilliant at paying a consistent dividend. There's a lot of money had been wasted in recent years on green energy projects, that it wasn't particularly clear that they were going to make returns over the longer term, etc. But at the same time, when a crisis emerges, like the Ukraine war, for example, you wouldn't want to have zero exposure to the energy sector, because that is a big performance headwind if the whole sector is going up on the back of something like that. So we try to keep that balance in the portfolio. But yeah, some of the stocks are very, just blue chip, big names that you would recognise that are listed in Europe. They so 3i stands out as we do have some exposure and flexibility to take UK listed companies. But the reason we like 3i is for its main asset. So 3i is a private equity group, but their main asset is Action, which is a discount retailer in Europe. So the vast majority of its revenue is coming from the European side. But great company. I mean, Deutsche Börse, for example, it's a company within the financial sector. Obviously, it's the stock exchange. It's doing brilliantly in this period of very volatile markets, because they get paid for increased volumes of trading on their platforms. L'Oreal, a business that's just doing fantastically from emerging markets, so it's had a bit of a wobble, and the fact that China has taken a bit longer than people had expected to recover, and but the longer term growth for a company like L'Oreal has continued to pay its dividend through the years. There's just some really good opportunities there.
I think we're going to be done out of time. Thank you very much indeed for coming. Thank you for the presentation.